Hi, my name's Steve Walker from Promised Money. Today I'm talking about bridging finance, specifically the types of interest. I've just been writing an article on this and I thought, well, let's quickly do a video while it's fresh in my mind, because some of you probably can't read, I don't know. Anyway, so here's a quick video about the difference between those types of interest if you're thinking of a bridging loan. So we've got retained interest, we've got rolled up interest, and we've got serviced interest. Now, firstly, retained and rolled up are fairly similar, but what they mean in essence is that when you take out your bridging loan, a chunk of interest is removed from the amount that you get because you're borrowing the interest. So if you borrow £100,000 and there's £20,000 worth of interest, then that £20,000 is deducted, so you only get 80 in your hand, in very broad terms. There are fees and bits and bobs, etc., but in very broad terms. So if there's only equity for you to borrow £100,000, if the interest is added or deducted from the loan, then you'll get less in hand. You'll get £80,000 in hand. And I'll go through some numbers with you in a minute to explain the difference. If you're servicing the interest, then you are making payments each month, and therefore that chunk isn't deducted, so you get the whole £100,000, less fees, whatever. So the key difference here is if you can afford to service a loan, and equity is tight and you're trying to get the maximum amount out of the bridging loan that you can, then by servicing the loan, that you'll get more in your hand. By adding the interest, or deducting the interest from the loan, you'll get less in hand to the amount of that interest. So what's the difference between retained and rolled up interest? Well, retained interest is probably the most common and is the most simple. So if you are borrowing £100,000 and the interest rate for simplicity is 1% per month, and it's a 12-month loan, then 1% per month, that's 12%. That's 12% over the year. That's £12,000. So that £100,000 loan, they're going to say, right, we're going to take £12,000 off the amount that you're going to get. That's going to be deducted. Okay, so you end up not getting £100,000. It'll be £100,000 less £12,000, and then any fees, etc. Now, if you're doing rolled up interest, then what that means is they're actually compounding the amount of interest that you should pay. So if it's a £100,000 loan, after a month, it's 1 month's interest is £1,000. But then in the second month, because you're being charged interest on £100,001, the interest is a little higher. It's £1,010. In month 2, it'll be £1,021. So you've got that compounding effect of the interest over the 12 months. And the difference between that is small, but it is there. So with rolled up interest, you're going to end up paying slightly more in interest than you would if it was retained. But in both cases, it's deducted from the loan amount. You don't get that money. Now, people often make a mistake when they are taking out a bridging loan of thinking, oh, I can go and get a 75% bridging loan, and that's great. So if it's a £100,000 property purchase, I'm doing it to keep the math simple, I'm going to get £75,000 in my hand. Well, you're not, because first of all, the lender's going to deduct their fees, typically 2%, and there could be other costs, legal fees, etc., which could be deducted from that. Now, if you choose to have the interest either retained or rolled up, that's going to be deducted as well. So that could easily get you from 75 down to 65%, depending on the term of the loan. And of course, the longer the term of the loan, the more interest is going to be applied to that loan over the term. Therefore, the more that's going to be deducted. So, you've got a bit of a dilemma there, because you might be thinking, well, I'm taking a loan out, let's say you're doing a refurbishment of a property. I'm going to do a refurbishment of the property, I've got to get it finished, and then I'm going to sell it. So it's going to take me 8 months to do the job, let's say 4 months to get it sold, so I need a 12-month bridge. But it might not take you 4 months to get it sold, it might take you longer. So really you need to build in a safety factor there. So let's go for 18 months. By going for 18 months, that's an extra 6 months interest, which is going to be deducted from the loan, if it's retained or if it's rolled up. So that then takes you to place thinking, well, actually, that doesn't work for me because I can't actually afford to do that, because that won't give me enough money to get the deal done that I want to get done. So I need to look at another option. Well, another option could be serviced interest. And this is available if you can demonstrate that you can afford to service the loan. If you can't, you might already have a mortgage elsewhere and lots of other outgoings. You might not be able to afford that, but if you can, then you can apply for a service loan, and that's just like an interest-only mortgage. You pay the interest each month. The lender's evidence that you can afford to do so. That's what's in the contract. Therefore, they don't roll up or retain any interest. Therefore, you get the whole amount in your hands, less fees. So that could work for you. If that doesn't work, something to bear in mind is if you have additional security, you might be able to offer security over another property. So the bridge is over 2 properties, 3 properties, whatever, which then gives the lender extra equity so that even after you've taken off your rolled up interest or your retained interest over 18 months, 12 months, whatever it is, there's still enough to get the deal done for you. And that's much more common in it's a common bridging scenario, but more common in a development scenario. You know, if you're looking for development finance, sometimes additional security is offered, which means that you can get the amount you need. So the key thing here is whether it's retained, serviced, or rolled up, you're going to get charged the same rate of interest. But if you are borrowing the money, borrowing the interest, then you're going to get less in hand, and also remember you're paying interest on the interest. Okay, so you'll be paying interest on the bit that you borrowed. So that's one of the key things. You get less in hand, and you're going to pay a little bit more interest because you're paying interest on the money that you borrowed. But there are ways around it, as I say, looking at alternative security, changing the term. The key thing is talk to somebody about it, because it's going to depend on the circumstances, the type of loan that you're looking for. There are refurbishment loans at the moment up to 85% loan to value. So maybe get a refurbishment loan up to 85% loan to value. That gets you to where you need to be. So talk to an expert, and I hope that's been helpful. Before I go, I'm just going to scroll down, see if there's anything I forgot to tell you, because I've only just written this. No, that's it. Do subscribe, check out our other videos, and go to our YouTube channel, Promise Money, or promisemoney.co.uk. See you soon. Bye bye.